Welcome back, everyone. In today's episode of Portfolio Analysis, we're going to do a mid-year review of the performance of the portfolios in our 2021 challenge. This year is shaping up to be a lot different than last year, so I hope you stick around because there are some real surprises halfway through the year so far. Please remember, if you enjoyed this video or any of my research on YouTube or the website, please let me know by subscribing, liking the video, and writing a comment. Just for a quick recap, we're currently running an annual portfolio challenge where we take $10,000 and split it into 10 $1,000 portions, and then we invest each portion into a different investment portfolio. Our goal with the challenge is to find the best performing portfolios each year with the lowest levels of risk. I'm tracking these portfolios using a Google Sheets spreadsheet. The link to that spreadsheet is in this video's description, and it will be on my website. Well, that's if I ever get around to posting this video's transcript to the website. For each portfolio, we're tracking the number of shares we own, the price we paid for each share, the total cost basis, the annual dividend and our actual payout amount, the date we made the purchase, the current price, the current total value, the percentage of gain and loss, the weight of the position relative to the other positions in the portfolio, the standard deviation, and the Sharpe ratio. I'm holding off on updating the dividend and interest information until the end of the year so that the values here will match the real payouts from my brokerages. So these totals don't currently contain accurate dividend numbers, which will have a small impact on securities like bonds that derive most of their returns from interest. You'll notice that each portfolio has a gray line which represents a benchmark to compare each portfolio to. We don't actually own any of the benchmarks. They're included here as a simple reference that you can use to decide if it made more sense to just buy a single ETF rather than trying to manage your own custom portfolio. And last but not least, you should know that the standard deviation is a metric that we use to measure risk. The best portfolio should have a high rate of return with as little a standard deviation as possible. We use the Sharpe ratio to represent this idea of risk to reward. A Sharpe ratio value below 1 is poor, and a Sharpe ratio above 1 is good. A value of 1 basically means that the return you received is in line with the risk that you took. Also, each portfolio's name is a link to an analysis video that I've created which covers each portfolio. Feel free to watch these if you want more information about each portfolio and how it might or might not meet your specific investment needs. First up, we have the retail investor portfolio.
Hedge funds, they're gonna lose billions. Hedge funds, they're gonna lose billions.
For this one, we looked at Reddit and Robinhood's top 100 list in December, and we picked 10 stocks. The whole GameStop AMC meme phenomenon hadn't happened yet, but there was a lot of talk of GameStop and AMC around Reddit, so I did want them in this portfolio. Unfortunately, I wasn't able to get accurate historical data for AMC, so I ended up buying AMCX, which is not the same security as AMC, but it's all we could get, so it's what's in here. Now, having said that, this portfolio is still just ridiculous. We got a 950% return from GameStop, a 76% return from BlackBerry, 40% from Nokia, 86% from AMCX. So far, this portfolio has returned 118% in just 6 months. To put this return into perspective, this is like getting 14 years worth of broad market index fund returns in a single year. Obviously, to get returns like this, you have to take huge risks, and this portfolio is easily our highest risk investment with a whopping 129% standard deviation. Just for reference, we usually start to get really nervous when our portfolios reach the 20% standard deviation mark. I didn't really have a good benchmark for this portfolio, so I decided to compare it to Cathie Wood's ARKK Innovation Fund. So far in this year, the ARK Fund is badly underperforming in terms of risk to reward.
El cielo se está cayendo! El cielo se está cayendo!
Next up, we have the Dogs of the Dow strategy. Remember back in my 2020 portfolio challenge that the Dogs portfolio got beat pretty badly. This strategy is a great one, and I expected it to bounce back, which it has so far. It's given us a 19% return and a Sharpe ratio of over 2. Chevron is the best performer in the portfolio so far this year, which makes a lot of sense considering how well oil has been doing. Next up, we've got our custom core coin portfolio. This is basically just a core 4 portfolio where we've swapped out the real estate for Bitcoin. If you haven't seen my video on this portfolio, please go watch it. I've really struggled with how to talk about Bitcoin on my channel, and that topic has come up so often that last year I decided that the best option would be to create a portfolio with Bitcoin in it that would actually be safe and it would remove most of the risk. The core coin really has made me proud. Bitcoin has recently crashed, losing half of its value. How did our core coin portfolio handle that crash? Well, frankly, like a champ. The Bitcoin holdings are still up almost 15%, and the overall portfolio is up 9%. You'd expect a higher standard deviation given the magnitude of the Bitcoin drop, but no, that's not the case. The other assets have buoyed the portfolio admirably. Next up is the Warren Buffett Family Trust. This portfolio is effectively just a 90-10 split across U.S. large caps and short-term treasuries. 13% return so far. Interestingly, the Vanguard Total World Benchmark returned slightly less, but at a better risk-to-reward ratio. This is one example where maybe buying the single ETF was the better choice. Portfolio 5 is J.L. Collins' Simple Path to Wealth. This is the Millennial Edition version that puts 100% of the money into the S&P 500 with no bonds. This is a little odd. VTI and VTSAX are the same fund. The only difference is that VTI is the ETF, whereas VTSAX is the index mutual fund. Not exactly sure how they ended up with different returns. It may have to do with the fact that mutual funds can only buy shares at the end of the trading day, so maybe my entry prices were different. Not sure about that one. Next up, we have the Global Technology Portfolio. This one is composed of 80% NASDAQ 100 Technology Index and 20% NASDAQ 100 China Technology Index. The US Tech Fund, QQQ, has had some rough months in Q1, but it's bounced back at this point, sitting at about a 13% return. QQQ is actually beating the Vanguard Technology Fund, ticker symbol VGT, which by the way is one of my personal all-time favorites. The China Technology Fund is down about 3.5%. That ETF has been up and down all year. Our 7th portfolio in the challenge is last year's shocking winner, Scott Burns' couch potato portfolio. My, how the tables have turned. Those long-term treasuries have just conspired against us, and they're dragging this portfolio down. Still, all in all though, a good year at this point, returning about 4% or so. Next up, we have the all-weather portfolio. Now this is probably the portfolio that my channel is most known for. My all-weather video is one of my earliest ones, and I made some rookie mistakes, like I incorrectly described standard deviation and some other technical errors in my rush to get a video out, but it is what it is. I'm sure it won't surprise you to learn that I still love this portfolio. and that my wife and I actually still use this and have used this portfolio for years as our general everyday savings account. At the moment, the gold and bonds are dragging it down and it's getting beaten by the 60/40 portfolio, but it's still up 2.5%. Next up, we have PortfolioCharts.com's Golden Butterfly. Given the gold and bonds in this one, you'd think that this portfolio would be doing lackluster, but that small cap value ETF saves the day with its massive 29% return. This portfolio overall has returned over 5% so far this year, which is a great showing. And holding up the rear at number 10, we have the good old Paul Merriman Ultimate Buy and Hold strategy. Of all the videos that I've made on this channel over the last year, my video on the Ultimate Buy and Hold is easily my most controversial. A lot of viewers really hated it because the data that I used only went back 30 years or so, and that data didn't create a positive image of this portfolio. Well, that was then, and this is now, and today the Merriman strategy, which is heavily loaded with value, small cap, and international assets, is a beast in 2021. 16% return with a whopping 4.47 Sharpe ratio. Okay, so which portfolio provided the best return with the lowest level of risk in the first 6 months of 2021? Well, oddly enough, that BlackRock benchmark pension fund that we're not even invested in produced the best risk to reward so far. Following that, the passive total world benchmark VT is the runner-up with a fantastic 4.62 Sharpe ratio, also a portfolio that we are not currently invested in. Well, what about the portfolios that we actually own? Well, you probably guessed it by now. The Merriman Ultimate Buy and Hold and its 4.47 Sharpe ratio takes the cake, followed by the Simple Path to Wealth's great 4.11 Sharpe ratio. In terms of raw returns, irrespective of risk, obviously this crazy retail investor portfolio did the best, but that's not a real sustainable investment, and I wouldn't take that seriously since it's likely to implode at any moment. I think the Dogs of the Dow deserves an honorable mention here. That portfolio returned an amazing 19% in 6 months at just 14% standard deviation. The dog strategy is a great example of how individual stocks can be grouped together to reduce their risk and accentuate their returns. I think this strategy proves that you don't have to go 100% passive all the time to get great investment results. The next 6 months are really going to be interesting to watch. I can't wait to see how these portfolios perform over the full 2021 period.
That's my quant.
Your what?
My quantitative. My math specialist. Look at him. You notice anything different about him? Look at his face. I'll give you a hint. His name's Yang. He won a national math competition in China. He doesn't even speak English. Yeah, I'm sure of the math.
Anyways, as always, thanks for watching and sticking around to the end. And please don't forget to subscribe, like the video, and maybe even leave a Bitcoin donation if you'd like to support my work. My crypto addresses are all in the video description below. That's it from me today. I'll see all of you in the next video.